I think the bond market is the center of the universe right now. What you're seeing in markets is the bond market moves and everything is reacting to it. Yields are down, so the stock market is up, and vice versa. What is happening in the bond market? And you'll hear a lot of people talk about positioning, basis trades, levered traders, China selling, Japanese banks in trouble. And some or all of that might be true, but I always like to say that positioning never ever creates a trend in markets. Something else creates a trend in markets, but positioning can exaggerate the move. And I think that that's what it's done. Last week, the bond market had, let's take the 30-year bond. It was up 46 basis points. That's its biggest one-week rise since 1987. I think that over the last 2 weeks, the Federal Reserve has made it very clear they're worried about tariff-driven inflation. We're going to get tariffs of some degree. Even though Trump has backed off of some of them, he hasn't backed off all of them. We're going to get tariffs. That means that we're going to get higher prices. That means that the measure of CPI is going to go up. And the Fed has said, look, we're going to see higher inflation prices, and everybody's talking about that we're going to have a recession. We're not going to cut rates. We're going to have to hold the line because tariff-driven inflation looks problematic. That upset everything because the perception is the minute the economy wobbles or has any kind of problems, don't worry, the Fed will cut. If they have to, they'll cut to zero. If they have to, they'll print money. They'll do whatever it takes to try and stimulate a weakening economy. Now what they're saying is, good luck. We're not going to move. And I think that's what started to move higher in rates. And that shock, that worldview has been changed, created a scramble to get out. And then with all these leverage traders and basis traders and Chinese selling and Japanese banks having issues, overdid the move. I'm at 50-50 on a recession right now. We're a capitalist economy. I know, insert joke here about when I say we're a capitalist economy, but we are. And that means that a capitalist economy always kind of remakes itself. So the natural state for our economy is to grow. 90% of the years since World War II, sometimes we grow slow, sometimes we grow fast. A recession is what the economist from the 1970s, Rudy Dornbush, quoted a famous line, right? Economic expansions do not die of old age, they're murdered. Some event happens, scares the hell out of everybody. We stop doing economic activity and the economy contracts. The last one was COVID. The world shut down. That's what caused the contraction in the economy. So the big question is all this tariff hysteria going to get people to say, do what they say? I don't know what to do. I don't know if I should hire. I don't know if I should be importing or exporting. So I'm going to do nothing. I'm going to stop economic activity. If the answer to that question is yes, then we're going to have a recession, and I'll put it at 50-50. Why isn't it much higher than that? I'll just remind everybody, 2 years ago, we had Silicon Valley Bank fail, we had Signature Bank fail, we had Republic Bank fail, and we had Credit Suisse fail, all within days of each other. Collectively, it was one of the biggest run of failures of banks that we've ever seen, 2008, and then you got to go back to the Great Depression. 2 years ago, we were saying exactly the same thing. We're going to have a financial crisis because of all these bank failures. And banks aren't going to loan, and people are going to change their habits. They're going to be scared about the stock market. It had corrected more than 10%, and we never had a recession. So just because everybody's saying that they're going to do this and that doesn't mean they will stop doing economic activity, but there's a real high probability that they can. That's why I put the odds at 50-50. And how long will a recession last? Until they kind of get some semblance of an all clear and they can go back to their economic activity. Just like the last one was, once we reopened, the recession then ended. But that's what we have to understand what a recession is. It's an unusual event. Economies don't die of old age. They just don't roll over because there's a certain number of years and that's it, and we have to start contracting. It's a war, it's an oil embargo, it's a pandemic, it might now be, unsettlement about tariffs and the like. Those are the types of things that cause recessions. In the next couple of months, the question really becomes, are we going to see dramatically higher prices because of tariffs? If the answer is yes, we could very well have a recession, and then the Fed will say, because of higher prices, we're not going to cut rates. 71% of the sellers on Amazon source their products from China. So you should expect, all things being equal, even though we're not at 145% tariffs, which was the peak that we threatened, we're still up, I think, like in the 80 or 70% point of all in tariffs when you add all of the different variations in. We should see dramatically higher prices on Amazon within weeks. They've still got inventory that they can work off that they've got with the lower prices. But unless there is a quick resolution to this, there should be much higher prices there. Anything at, 10% of what's on the shelves at Walmart comes from China as well, too. We should be seeing dramatically higher prices at Walmart within weeks. And if that does happen, you're going to get two things. You're going to get a dramatically higher CPI number, and you're going to get people to change their behavior, stop economic activity, and possibly have a recession. Now, if on the other side of the equation, we don't see higher prices, and that's always possible that somebody eats it, either the supplier or the importer, either Walmart eats the price or China somewhat eats the price. Or I've even read a story now that we're actually collecting no tariffs because the customs agency doesn't know what to do because we change it every 5 minutes. They don't know what they're supposed to be collecting, so they're not collecting any. But I suspect that won't last more than a few more days. But if we, for some reason, don't see higher prices in weeks, then we might not have a recession at that point. So that's the great unknown when it comes to what the economy is going to do. Yeah, I think it's a lag and it's a timing issue. Actually, what you're referring to is the price of crude oil is down a lot. But the national average, AAA, the Auto Association, puts out a national average for the price of gasoline, and it hasn't fallen but 2 cents in the last couple of weeks. Now, that might be coming in, the next 10 days to 2 to 3 weeks. We might be seeing gasoline prices coming down quite a bit. Now, one of the things that people have to also remember about CPI, which is kind of useful, is they do extensive work in trying to figure out what our basket is, what we as a country spend our money on. And they've got CPI, gasoline's weighting at 3%. So 3% of the average budget. Now, some people pay more, some people pay less, but the average budget is 3 is what we pay on gasoline. So yes, falling gasoline prices will help, but it's only 3% of the budget. Now, when it comes to things like clothing and food and other things, hardware we need and everything else, the stuff we buy on Amazon, that's actually a bigger part of our budget. And we're talking not about those prices going up 1 or 2 or 3%, right? We're talking about an 80% tariff on Chinese. These are hard to fathom numbers that we're talking about. A near doubling of prices. When we're talking about 3% of our budget is on gasoline, and maybe if all things are equal, we'll have about an 8% drop in gasoline prices. So does it offset? Yes. Will it completely offset? Well, if we are going to get the type of price increases that we are expecting, the answer is no, it won't completely offset it. And we'll see much higher prices as we go forward. The market is putting a 20% chance that the Fed is going to cut rates at its meeting on May 7th, meaning 80% chance they won't cut rates. What more does the Fed need to see? Everybody's calling for a recession. We had a 20% correction in stocks. We've got markets that are dysfunctional, and yet they're not going to cut rates at their next meeting. Oh, but they're going to wait till the June meeting. I didn't know that's the way the Fed worked, right? The shit hit the fan, but don't worry, you'll get a rate cut in 90 days. It's usually the shit hits the fan, you'll get a rate cut in 90 minutes is the way the Fed is supposed to work. So that doesn't seem to sit well with me, is that no, they're not going to cut rates in 90 days if everything's going bad. They're not going to cut rates, period. And that's because of this inflation thing. So if the funds rate holds at 4, I think that the 2-year note historically, if you look at the 2-year note yield to the funds rate, it's about 40 to 50 basis points. So that means if the funds rate's at 4, then that means that the 2-year note should be around 4.40 to 4.5. It's a little bit below that right now. And historically, the 10-year note trades about 1 full percentage point above the 2-year note. That's 5.40. Well, we're at 4.50, 4.40 right now on the 10-year note. So we've got a little ways to go. I think that fair value is going to be somewhere above 5% on it. And I would emphasize that word fair value. When I say, we're going to go above 5%, everybody gulps. Oh, what's it going to do to mortgages? What's it going to do to the economy? What's it going to do to borrowing rates? And the answer is, if it's fair value, it's going to be fine. Yeah, I'm old enough to remember the 80s and 90s. Those were the rates that we had. My parents had a 15% mortgage at one point, and homes traded and the economy continued to move forward because that was the appropriate interest rate for that environment. And that's why I say fair value. The appropriate interest rate for this environment, I think, is going to be a 5% yield. And that we're just not ready to accept that because we're still anchored to that zero interest rate we had throughout the 2010s. And we have to kind of realize that that era ended and now we're in a different era. So even if we get a 5% rate, that doesn't mean that it's going to be bad. It's just the world we live in. If you look at the consumer balance sheet, the consumer is largely a net beneficiary of higher interest rates. So we have $7 trillion in money market funds. We've got trillions of dollars we own in bond funds and annuities and everything else. So when interest rates go up, our interest income is going to go up. Now, for those that are borrowing, when we talk about, 7% mortgage becoming an 8% mortgage, for those that are taking out car loans and stuff like that, that's going to be a net negative. But as an economy as a whole, I think it's a net benefit. Now, the problem is the people that are getting the interest income tend to be the wealthier. They have investments and and they own annuities and bonds and have money in money market funds, and those yields will stay up and throw off them interest income. Those that tend to borrow tend to be less wealthy. If they were wealthy, they wouldn't need to borrow. And so they're going to be hurt. So it will have a disproportionate impact on the economy, that so-called K-shaped economy. The lower half of income will be hurt a little bit worse than the upper half of income. And it's the same thing with corporations too. If you look at corporate balance sheets, they also, I think, are kind of a wash to a positive benefit for all of the levered companies that need to borrow to keep going, that are going to be troubled by higher interest rates. You've got a Microsoft, or you've got, actually the better example is Berkshire Hathaway. Warren Buffett is like the 6th largest owner of treasury bills in the world. He owns more than some foreign central banks do. It's like $300 billion worth of them. So if you tell Warren Buffett that he's going to continue to get a 4% interest rate, he's going to get like $12 to $14 billion a year just sitting on a pile of treasury bills. So that's also got to be factored into the equation too. But again, Berkshire's not going out of business. Microsoft, which is in somewhat of a similar, is not going out of business. But some of these levered companies that need lower interest rates might very well go out of business with higher interest rates. So it's not uniformly, but at the top line for the economy, higher interest rates should not be a negative for it.